UNH has been hammered today, down 7% on the back of the Humana news that we covered. Now, this is one I do hold in my portfolio, and I have added shares of this company today for full disclosure. Let's take a look at this company. Let's look at the historical performance. Let's take a look at their top line revenue, their bottom line net income growth over the last few years. Let's also analyze their total cash versus their total debt, a quick health check. And we'll take a look at how they have performed versus their competitors over the last few years. We'll dissect their dividend safety and their financial metrics. We'll also have a quick look at the insider buying and selling that's taken place. And as always, we will have a quick peek at what the institutions are doing. And as always, we will run them through our valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety. And we'll take a look to see what Wall Street are forecasting over the next 12 months. So let's jump straight into the analysis of this company. Now, they are down 7%. Over the last year, they're down 3%. We can see them trading towards the mid to lower end of the 52-week range with a forward PE of 18.5 and a forward yield of 1.47. Over the last 10 years, if you have been holding this company, you would be up 564%. Bear in mind that doesn't include those dividends reinvested, and this is one that does tend to outperform the S&P 500. Now, in terms of their revenue top line, what we like to see, 3 to 7% growth year on year. What we can see, 242 billion reported in December 2019. Now, we have their latest accounts, they're December 23, and they reported 371 billion. Now, this is what I like to see, consistent growth year on year, those nice increases, very positive over the last 5 years. Now, when we compare that to the bottom line net income, what story do we see? 14 billion reported in December 2019, 22.4 billion in 2023. So again, a nice increase to that bottom line, and we can see those increases consistently year on year. So far, so good, very good in my opinion. Now, the cash versus their total debt, how is this company looking? 11 billion cash in December 2019, latest quarterly report 25 billion. So they are holding around 2.5 times more cash than they did 5 years ago. Now, when we compare that to their total debt numerically and directionally, 41 billion in 2019, 62.5 billion in their latest quarterly report. So yes, in actual fact, their cash has increased, but we also note a fairly substantial increase to their total debt, and we'll cover that under the net debt to EBITDA metric shortly. Now, in terms of their performance versus some very well-known competitors, we have Alliance Health, which also dropped today, Humana, which, as you know, dropped significantly, and a few others. Now, over the last 5 years, including those dividends reinvested, in fact, just over the last year, UNH is down 1%, pretty much the middle of their peers. When we extend that to the last 5 years, UNH is the second best performing, as we can see, up 93%. Personally, over a 5-year period, if you're getting back 93%, including dividends reinvested, it isn't too bad. Pretty much in line with Alliance Health, which is just a few percentage points lower. And we see Molina Healthcare, in fact, the highest performing. As always, whether or not you're happy with this performance, remember past performance doesn't equal future performance. Quick look on the screener for the last 3 years, insider buying or selling. Regular investors know insider buying, very bullish signal. Insiders really only buy if they believe the share price will go up. Insider selling, not necessarily bearish. They do sell for different reasons, whether that's personal or financial. We can see the director did sell around 66,000. In fact, a total of 36 million in December. Fairly recent, but again, personally, I wouldn't read too much into that. Now, in terms of moving on to the institutional ownership, it does sit around 86%. Institutions have sold around 56 billion over the last 12 months, but over the same period they have bought a significant amount more. So in general, institutions do quite like United Healthcare, and we can see the largest institutional buys in Q2 of 2023. Otherwise, we do notice quarter upon quarter there isn't a lot of activity for these institutions. And in their most recent one, we see 1.53 buying versus 457 million selling. So yes, institutions do quite like this company. But as I always say, do not go off what institutions do and always do your own due diligence. So let's jump into the dividend safety. The score is 99. It is very safe. Market cap 475 billion, a mega cap company. Last recession, while they maintained the dividend, they didn't increase it, but they also didn't cut it. Above average growth, plus 5% versus the S&P's negative 12%, but they did unfortunately underperform the S&P with a negative 63% return, and we see the S&P's negative 55%. Dividend growth, this is what I really like about United Health. Double-digit increase in June 23, 16% increase over the last 5 years, 41% increase over the last 20 years. Absolutely phenomenal. So on top of the share price appreciation, if you held this over the last 20 years, every single year on average, the dividend would have increased 41%. Now, they have been increasing those dividends for the last 14 years. Dividend yield theory, now it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. In fact, we have a double sign of undervaluation as the forward PE sits below the 5-year average. But do bear in mind that we never look at any of these models in isolation and will draw our conclusions towards the end. We also see United Healthcare 17.2 PE versus the healthcare sector PE, which is pretty close. In terms of the free cash flow, as always, earnings data available if you want to see it. My only suggestion would be that it is essentially manipulative by management through accounting. It is susceptible, in fact, so I would personally ignore it. Below 60% is my target for the majority of companies on the free cash flow payout. Gives me faith that we can continue, especially for United Health, see those double-digit increases to the dividend. 2023 at 27%, very, very strong, and I do love seeing that consistency. In terms of the free cash flow per share, this is probably one of the most consistent companies that increases their free cash flow year on year. Yes, we do see 1 or 2 periods where it isn't very consistent, in fact flat, but over the longer term, this is one of those. If you have seen this channel, you have watched many videos, you will be able to agree with that statement. In terms of sales growth as well, we like to see 3 to 7% as a steady, moderate growth baseline. Last 3 years, double-digit increase, 2023, 15%. I am liking this a lot, seeing that consistent growth. At a minimum, we have seen 6%, which is okay given it is within our 3 to 7% radar. But there are lots of years where we see double-digit increases to the top line. And we can see their top line has pretty much nearly tripled from 130 billion to 372. Now, one area that United Health, in my opinion, they could do better, like Alliance Health, they do quite a lot, are those share buybacks, returning excess cash to investor pockets. Now, with United Health, we can see they do share buybacks. It is fairly sporadic, it isn't consistent, but I would like to see them buy back a lot more shares, my own personal opinion. ROIC, as always, regular viewers, you'll know that I don't particularly like to invest in a company unless we see a minimum of 10% ROIC. This is the number. It gives me faith that management are able to effectively allocate their capital. What are we seeing here? We're seeing consistently around the very high teens. In fact, 2023 at 20%. This is what I like to see a lot. Now, operating margin, free cash flow margin in this industry is a struggle. But if you have been watching the videos where we do run through the healthcare companies, you will see that actually around 8 to 9% is pretty strong. We have some that are around 4 to 5%. So for me, given that not only we are comparing it to most companies at that 12%, but in terms of comparing it to the sector comparables, 9% is something I can live with. And on the free cash flow margin, it is above that 5% over the more recent period. So I am happy with that moving forwards. On top of that, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this metric gives us faith that 1, the balance sheet is strong if it is below the 3, and 2, that dividend is safe. Now, these are the numbers, in fact, show us the number of years it would take the company to pay off all of their debt net of cash on hand. 2023, 0.9 very, very strong. 2024 expected to go even lower. I mean, look at the trend from 2019. It has started to come down. This is giving me faith that management are very, very strong in this case. Now, let's jump to the valuation. As always, if you enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we jump into the valuation, just to let you know, we have dropped our first free weekly newsletter. Every single weekend, we're dropping one article. Last week's was how we identify and screen for undervalued companies. We run through our 7 golden dividend metrics. This Sunday, we are going to be doing a deep dive on a very undervalued company that we do believe is a strong buy. So now let's jump into the valuation. As always, we start off with Graham's valuation. Now, as we saw, their top line is increasing double digits nearly every single year over the last 10 years. It isn't going to be relevant for today's episode. So let's jump into the multiples valuation. We have companies in a similar sector and size that we ran through. We have their PE multiple, so we get the average multiplied by the earnings per share to give an intrinsic value of $394. Now, based on this model, we do have a sign of overvaluation, but as always, do bear in mind we're not looking at any of these models in isolation, and we'll draw conclusions towards the end. We then have the dividend discount model with the growth rate year on year, average growth rate at 16%. Forward looking, we've gone quite conservative in my opinion at 6.75. Again, we have a strong sign of undervaluation with the intrinsic value at $642. Now, the third model, we have the discounted cash flow model with the free cash flows year on year. Average growth rate is 18%. Forward looking, analysts estimating 10%. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. We get a very high intrinsic value, so a very large undervaluation signal. Now, the intrinsic value for today's episode of United Health, it does come to $610. And don't forget, if you click on the pinned comment below, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list. Now, margin of safety that we start off with is 10% if we believe this has a wide moat, strong financial metrics, good forward-looking data. Now, if you believe that, it is a buy up to 548, at 15% a buy up to 518, 20% 487, and we can see at 25% it isn't right there yet. Now, for me, as I have said at the beginning of this episode, I have been buying. This is one that for me in particular, a 20% margin of safety, I do believe to be very fair for United Health. It is a company that continues to outperform the S&P over the longer term. And at a 20% margin of safety, I just couldn't resist. This is one I have been adding. It is full disclosure right there. Now, in terms of what Wall Street forecasts, they do see around 25% upside over the next 12 months with a price target of $600. That's over $100 per share. Now, one of the reasons why I like this company, they operate in an industry that we will always need. This isn't dying. This isn't going anywhere. On top of that, if they did want to increase, or in fact they probably do every single year, increase those rates at least in line with inflation, it is something that people need, a necessity in my opinion. And as always, when we did run through just the business fundamentals and metrics, they were strong on every single one. The only one that I would point out to look at over time are those margins. But as I said, whilst we look for 12% or more in the majority of companies, when we look at a sector specific, they are outperforming the other companies on a purely margin basis. As always though, do let me know your thoughts in the comments below whether or not you do believe that this is undervalued and to a company that will be there for a very long time. And 3, if you want to let me know whether or not you agree that they will be able to continue to increase their prices, in fact higher than inflation in my own personal opinion. As always, smash the like button if you enjoyed today's episode, hit that subscribe and bell button, and don't forget, as always, have a great day and see you on the next one.